Hello, everyone. Welcome to the DBRS Morningstar Essential Digital Infrastructure webinar. Today is September 19th. We're starting at 10 o'clock, and I'll give maybe another couple of seconds or so for people to come on, and then we will begin. Okay, I think we will get started. So again, welcome to the discussion, the webinar on rating essential digital infrastructure. My name is Victor Leung. I'm a senior vice president in the project finance group here at DBRS Morningstar, working on project finance, and one of the analysts who covers a lot of digital infrastructure. We created the digital infrastructure methodology back in the earlier part of this year, around March. We have been seeing a significant increase in interest in this space, particularly assets such as data centers, fiber networks, and telecom towers, and decided to kind of create a methodology that was focused on these assets. The methodology itself is based on the project finance methodology, so really they are sister methodologies, and the essential tenets of these are the same. But there are some specifics, obviously, with respect to digital infrastructure, its characteristics that make it worthwhile to create a new methodology. As I noted, because this is the essential digital infrastructure methodology is rooted in project finance, it might help us to review digital project finance very quickly. Project finance is based on structure and risk mitigation. Um, and it has certain benefits to issuers, including the ability, based on its kind of risk mitigation structure and its recourse only to project assets and cash flows, to offer long-term debt, which mirrors what we feel as long-term stable and reliable revenues from the project. A well-structured project with good risk mitigation will correspond to low debt rates, um, and debt sizing based primarily on cash flows. So unlike a corporate, which actually some digital infrastructure can be rated as corporate as well, the project finance and essential digital infrastructure methodology is really based on cash flows only. So we do not look at the asset values per se, nor do we look at metrics such as LTV, which often advisors come to us with these metrics on. There is obviously some correlation between, LTV um, and the cash flow based DSCRs that we use, but it is a sort of indirect linkage. A key part of project finance is that it is well structured. And what that means for digital infrastructure issuers in particular is that some of the flexibilities that issuers may be looking for, and which is more common in digital infrastructure, such as the ability to acquire new assets, acquire new data centers and put it into the structure, for instance, acquire new territories and put it into the structure, for in the example of say telecom towers or fiber networks. Those are more restricted under project finance. And usually subject to a number of kind of lender covenants as well as rating agency restrictions. And these restrictions actually are the reason why we consider that a project finance or EDI based uh, rating has some risk mitigation to it, and why it is able to support a higher amount of leverage at a higher debt rating. We expect digital infrastructure. So the methodology makes reference to essential digital infrastructure. And in our view, not all digital infrastructure is essential. But what makes digital infrastructure essential such that it can be rated using project finance or the EDI, essential digital infrastructure methodology, is its characteristics, which include um, such such characteristics as being kind of a monopolistic or oligopolistic position or some other strategic advantage with very high barriers to entry, continuous and long-term demand, resulting in long-term steady and reliable cash flows under a government support or regulatory framework. So this is fairly important from our perspective um, because the project finance and digital infrastructure finance methodologies really assume long-term stable cash flows. Long-term stable cash flows usually come from some sort of regulatory or market decision that protects those cash flows and make them very sticky. Um, in project finance, we usually expect long-term revenue offtake contracts. In digital infrastructure, we recognize that that sometimes doesn't exist, at least not to the degree that you see in project finance. But nevertheless, there have to be structural features there that really render those cash flows sticky and long-term. So in the case of towercos, for instance, the fact that it's difficult to build new towers and the essentiality of those towers to the operations of a telecom company is good reasons to consider that that cash flow would be very long term, notwithstanding the fact that maybe some of the offtake agreements may be shorter or contain breakpoints or releasing points. Um, it is actually these characteristics that define what essentiality means in digital infrastructure. So the asset type by itself doesn't necessarily make it an essential infrastructure. A good example of that would be a fiber optic network and a cable in a low demand or low usage area, which doesn't, in our view, carry perhaps the same sort of stickiness as one in a more dense or in a more high demand area would. So it is important to note that the asset type itself doesn't define it necessarily as essential digital infrastructure, but the characteristics and the market conditions and the government regulatory support or other features that make it so. There are three types, or we really look at three types of digital infrastructure. Um, these are where the demand so far that we have seen tend to be coming from. The first is data centers. So actually a lot of the demand that we see and a lot of the inquiries that we see are focused on this type of asset. Um, what we view to make them essential are kind of wholesale tenant arrangements and long-term tenant leases with kind of very high probability of releasing. Again, it's due to the stickiness of the tenancy and the essentiality of the facility to the operator of the data center. Another type of key of digital infrastructure are towercos. These are typically mature tower assets that we see situated in densely populated areas or towers that are built for coverage reasons, coverage mandated by governments, for instance, are required to be there whether there is a significant demand or not. And so, tower codes are something that we see and have rated particularly as essential digital infrastructure. Fiber optic networks are assets that we are beginning to see more of. These tend to be perhaps a little bit more end user focused. We may not see the type of long-term contracts in these assets that we see in some of the other assets. But nevertheless, there are some characteristics in certain transactions and certain structures that make fiber optic networks fit under the essential digital infrastructure. And so we have rated assets with these type of assets under this methodology. As I mentioned, the digital infrastructure methodology is predicated on the project finance methodology. The framework of this methodology is divided into a construction phase and an operating phase. Very often assets come in that are already in the operating phase. And so the construction phase is sometimes less applicable, but nevertheless, we are seeing more interest in construction. And I think part of this has to do with the fact that as digital infrastructure becomes more essential, as the demands of new applications such as AI take into effect, the capital costs of these assets become that much higher, and therefore, issuers are looking for financing partners to help finance and fund these build-outs. We assess each phase as applicable independently. So the construction phase will be assessed according to construction methodology. The operating phase will be assessed according to its kind of operating methodology. Um, and the lesser rating of the two will be the governing rating. What that does mean is that if the construction phase ends up being lower rated than the operating phase, which very often is the case, the rating may be constrained by the construction phase until such time as the project has successfully completed the construction and has kind of gone into operations. The construction phase as a whole is built on top of the contractor's credit. So basically, the construction contractor assigned the bulk of the construction work. We view that as anchoring the construction phase. But the rating can be improved with a number of construction enhancements. We'll get to that in the next slide. Similarly, the operating phase has assignment of rating levels for individual rating drivers. And so this is a more qualitative assessment of the operations, followed by a rating level of the financial metric, and a weighted average of these drivers then results in the operating phase rating. The overall rating can also be notched up or down with appropriate over a set of overlays, and we'll get into that in the next couple of slides. So as I mentioned, the construction is generally the riskiest phase of the project. And a strong general contractor who commits to a fixed price date, certain either EPC, guaranteed maximum price contract, or something along those lines to design and build the project, ideally allocates a lot of construction risk away from the project investors. And essentially, that is the reason why we see that the ability to construct a project on time and on budget is essentially rooted in the general contractor's rating. The quality of the contractor must also be assessed against the complexity of the project. So clearly, a complex project carries more risk than a relatively simple project. And so therefore, even a highly rated construction contractor undertaking a difficult project, we may kind of reduce, I guess, the anchor rating as a result if we feel the project is relatively complicated. For digital infrastructure in general, we view the construction to be relatively straightforward to medium risk. So that kind of restriction may be less applicable, but nevertheless, we will assess, on an individual basis. The construction contractor's rating does not form the end all of the construction phase rating. We can kind of look at additional securities or additional supplements and credit enhancements, such as letter of credit that enables additional liquidity to deal with adverse situations, provision of performance bonds, parent company guarantees, liability caps, and things of that nature, which can be assessed to uplift the rating of the construction phase above the rating of the construction contractor. On the operating phase, the rating drivers are kind of based both on a qualitative assessment of the project or of the asset, as well as a quantitative financial metric. The operating phase rating drivers, qualitative ones, include the revenue stability and the offtake agreement, how we view the stability of those cash flows and the tightness of an offtake contract, the competitiveness of your asset and where it's located, operating risks and operating risks and costs. Technology risks, we are talking about technology assets after all. And so a technology asset which is subject to obsolescence is something that we will look at, as well as the sponsor's strength and commitment, and other financing considerations such as the amount of reserves available, whether or not you have substantial refinance risk, etc. And that is then kind of combined with the financial metric, which is really basically debt service coverage ratio based. So the DSCR is a very important part of project finance. And to a lesser extent, cash flow to debt, because that is a metric that issuers use often to evaluate digital infrastructure assets. It's important to note that when we do our financial analysis, we actually do a complete um, cash flow projection throughout the term of the debt, including any refinance if appropriate. Um, and so for items or for projects with leases that have breakpoints, for instance, or other types of termination provisions, we do assess that and project the cash flow accordingly. Um, Unlike what certain issuers or advisors may be used to, and look at the value of the asset at the time of those breakpoints. So that is a kind of an important thing to note. And as I said, so the construction and the operating phase then get combined into an overall rating, and the lower of the two phases will govern. Um, that base rating can then be subject to a number of overlay considerations, which we view as being applied to the kind of rating as a whole, and that may result in notching upwards or downwards depending on the characteristics of that overlay. I won't go into all of them here. They are outlined in the methodology for users to read if you are interested. But just to note that that overall rating can be subject to certain overlays that would be that can be applied. So that is the overall kind of approach, I guess, to rating digital infrastructure. It is very similar to the project finance approach, and actually, quite honestly, kind of fairly similar also to the way that DBRS Morningstar rates corporate issuers as a whole. I do see some questions, and we will address those when at the end of the presentation. So thank you for those questions. I just wanted to make that we do see those. So probably the most important or the most useful for issuers are case studies to see how we actually apply the principles that we talked about just now. And so we presented a couple of case studies here. The first is a TowerCo project. So this is a project that we rated of a set of telecom towers portfolio in 3 European countries. The operator or the owner of these assets has towers in these 3 European countries. These towers are then leased to 5 national telecom companies in those towers. It's actually kind of initially done as a sort of sale leaseback transaction. The towers are all in mostly urban areas with the telecom tenants. And there's a population base of roughly 30 million. So from our perspective, we see that as very urban-based asset, which adds to the long-term essentiality and stickiness of the lease revenues. The average life of the telecom leases themselves, that are leased to the tower to the telecom companies, are 18 years. But there are breakpoints and there are renewal points. The debt is comprised of 10-year bullet bonds. And so while the life of the lease is beyond the maturity of the initial debt, there is a significant refinance risk to that. And so we view that we would look very closely at the probability of releasing when assessing the refinance risk. The company has a very strong and experienced sponsor who owns many of the digital infrastructure assets. So from our perspective, when we look at a case like this, we see stable, predictable, and sticky revenues. The contractor largely was very high telecom or high investment grade counterparties. we see the essentiality of the tower business with historically minimal churn and generally low operating costs and maintenance requirements for the typical of a tower co. Weaknesses, as I said, the primary one is a refinancing risk. Um, a significant portion of the contracts are evergreen and can be terminated with notice. And that to us, represents a risk in terms of the termination. The tower codes that we see often have clauses that specify that the off-taker must terminate. If it terminates, it has to terminate all their towers. But not all of them have these type of termination clauses, and so you may end up with gradual and steady churn over time. Um, so you're actually what we want to do here to actually present how we kind of assess these assets in a rating committee. This is the actual kind of matrix and grid that we use. So we're trying to open the kimono a little bit here. Unfortunately, the shading of the assets or the shading of the characteristics did not come through this slide, but I will make sure that when these slides get circulated around, the shading is included so you can see how we arrived at the various rating factors. But in this case, I will just talk through this. And so when we assess the rating factors against our criteria, we see that we assess the revenue stability of the TowerCo at a triple B high, and that is generally because we see many characteristics which are in the A range category, including long-term contracts generating stable cash flows with infrastructure that is very critical to the off-takers and very difficult to substitute. But on the lesser side of it, on the triple B side, we see that the contracts are over determined financing with consistently kind of competitive position, but there is releasing risk, and so therefore not everything can be in the A range. And as a result, we give it a triple B high assessment there. On the competitive side, we assess the tower code to be an A low, primarily because of a very superior competitive offering. Providing strong economic rationale for the contracts to be released. Essentially, the essentiality of the asset gives it this A low and the difficulty of substitution. So, very high barrier to entry in terms of building these towers that supports that assessment. O&M risk, we actually assign it a triple B. Now, that might be a surprise to some people with a knowledge of familiarity with tower codes. Because they do really have very low O&M risks and are generally on fairly low proven technology. However, we also believe that the technology is subject to obsolescence risk. So for instance, when you get to 5G, you already have to go and strengthen the physical towers themselves in order to support many of these kind of deployments. And so you do have this type of obsolescence risk. Technology itself is always subject to some sort of obsolescence curve. As a result, we would feel that that kind of risk kind of constrains that O&M rating to a triple B. For the technology risk, we actually do feel that as a triple B high. Again, because of the fairly important nature, I guess, of of tower codes, and the fact that kind of transmission technologies are something that if there were to be replacements, it is something that we will be aware of well in advance because technology actually does take a while to make it from a research and development phase into, I guess, a more commercialized phase. Sponsor strength and commitment, we assess at a triple B high, again, because of the nature of this particular sponsor. And then for other financing considerations, we view the financial projection to be fairly reliable, with fairly high confidence of being achieved, and reserves meeting a traditional project finance standard, 6 months DSCR, things of that nature, to result in triple B high. On the FRAs, we, according to our financial analysis, the minimum DSCR of this TowerCo, as came up to around 1.4 or so. I have to emphasize that that is actually based on an assumed assumed amortization. As I noted, the TowerCo, the structure itself was bullet bonds, which actually resulted in a fairly high DSCR because of the interest only of well above 2, which technically would result in the rating of an A. But because it is a bullet bond, because project finance does usually expect that the debt structure be amortizing, um, we have kind of also assumed an amortizing structure to see what the coverage would be if one were to be put into place. We view that as a more accurate representation of the financial risk. And accordingly, when we apply a amortization structure, we get a lower DSCR with a triple B assessment and a somewhat lower assessment on the cash flow to debt. Fairly honestly, usually it is a DSCR that is a governing factor. The cash flow to debt does contribute, but it is rarely the governing factor. So when you put that all together, we end up with a final rating of triple B based on a kind of qualitative assessment on the rating drivers of triple B high, with 35% weighting and a FRA or financial metrics score of triple B, resulting in a core rating of triple B. In this case, we had no overlays, so the final rating came out to a triple B. Case study 2 is a public rating, actually. So if any of you are interested, you can go to our website and look for Vault, VALUT, like a big bank Vault. And this is a portfolio of wholesale data centers located in primary data center markets in the US, representing 35 megawatts of total critical load. To be quite frank, 35 megawatts of total critical load is not very large in the scale of data centers. The really large ones operated by Amazon, Microsoft, and the like have this type of a megawatt at a single asset. Or much higher. But nevertheless, we do view this portfolio as a wholesale data center, and therefore, again, very essential to the off-takers or to the tenants of these data centers. The data centers themselves are single-tenant wholesale facilities with counterparties which include well-established IT services providers. The lease structure is largely powered shell, so largely a triple N type of lease. Although there is one turnkey one with an SLA, meaning that the operations of the critical infrastructure, the power supply and networks that go into the data center have to be operated by the operator. And failure to provide that level of service will result in deductions under the SLA. All the leases are long-term leases, but with optional renewal points embedded into the total term. And the key part of our analysis there was to assess the probability of lease renewal at the time that they occur, particularly because all these lease renewals occur basically within the term of the debt. It's important to note that renewal of the lease is not actually a given. So in this particular portfolio, we did assess one data center to be weaker relative to the criteria that we have for data center renewals, and we did assume it to go off lease at its first renewal point to be replaced by a kind of much less profitable use. I will also note that the thesis of essentiality of stickiness of the leases was generally affirmed. Last year, one of the tenant counterparties did go into insolvency, not because of anything that happened in the United States, but for something that happened in the European operations, which unfortunately cross-defaulted to their US operations. But nevertheless, that lease was very quickly picked up by another operator and seamlessly transitioned over such that there was no kind of financial impact whatsoever. And so, we feel that kind of affirms the thesis of essentiality in many of our data centers. So the strengths, again, of these, stable, predictable, and sticky revenues due to the essentiality of the assets. The weaknesses clearly are the releasing and refinancing risk. There is some element of technical obsolescence risk that we see in data centers. The methodology does discuss that, and certain tenants which were lower rated or unrated. So again, when we get to the rating drivers and what we discussed at the actual committee itself, we assigned a triple B high to the revenue stability and or offtake contract. And really, this is based on the essentiality of the data centers and the view that largely the leases will be renewed, but without a certainty. So there were some weaker data centers there. One of them, as we said, we assessed as perhaps not having such a high probability of being released. But overall, we kind of assessed that as a triple B high. On the competitive side, we assigned the portfolio a triple B overall, kind of reflecting the general proven technology and reasonable cost competitiveness of this set of data centers, um, but with some limitations as well. O&M, we had kind of assigned them a triple B based on proven technology with predictable operating characteristics, with a long remaining life, but likewise reasonably stable O&M costs. And in the case of the one data center was in SOA, because that one actually formed a fairly large percentage of the revenue, that was subject to more risk, and so the O&M risk was kind of it's not what's assessed accordingly. As we get to the other technology risk, we assessed technology risk as the triple B high, essentially the kind of longer term nature of these data centers, and the fact that the underlying critical infrastructure of the data center, the cooling and the power supply, is fairly efficient, known technology platforms with kind of fairly strong near term demand. Some risk of obsolescence, but really more of a gradual decline, I guess, in the technologies or in the system's effectiveness, which we view can be mitigated to some degree by just general ongoing upkeep and maintenance. It is noteworthy that the leases themselves require that the tenants commit to maintaining the underlying technology and infrastructure at a certain level. The sponsor strength overall, Triple B, this was a fairly well-known data center operator. And so, with a reasonable track record, and then other financing considerations, Triple B, we assessed the financial track record based on reasonable projections of reasonably certain revenue projections. The fact that all of these leases have renewal points does make that revenue projection a little less certain, which is kind of one of the reasons for the triple B. When we get to the FRAs, we actually assessed the data center portfolio here at a high in terms of the coverage. Just because the structure of this financing was more closer to a kind of structured finance with a 5-year term, followed by a refinance, which was soft refinance. So the the inability to refinance, I guess, at that 5-year mark was not necessarily an event of default. But if you fail to refinance the debt at that time, what happened was that the structure enters into a cash sweep where all remaining cash flow after debt service and operating costs are swept up to prepay the loan. No dividend or distributions are made to the sponsor, which obviously creates a huge amount of incentive for the sponsor to refinance. And so given that structure, we did assess the interest coverage ratio as a high because it was fairly high. The cash flow to debt was lower at a double B high. But really in this case, what governed the assessment of the financial metrics was the refinance DSCR. So as I said, we actually do assume in project finance that the refinance must occur, notwithstanding the fact that the structure allows for the refinance to be pushed off, subject to, as I said, the cash sweep. We assigned or imposed an amortizing structure on it, and we look at what the refinance DSCR is and what that assumed rating level could come out to be with an appropriately conservative interest rate. And what happened was that the refinance comes out at somewhat lower than investment grade. A refinance DSCR of about 1.18 times is fairly low, corresponding to a double B low. Now, because it is a refinance, the very fact that the refinance assessment does not come out to investment grade does not necessarily preclude the original debt from being investment grade, but it can restrict or constrain the core rating of the initial debt. And in this case, we constrained it to a triple below, roughly one rating category above what the assessment of the refinance was. So on the rating driver score, we again gave triple B overall to the qualitative factors, a triple B, triple B low, actually, I should have said, to the FRA scores of the counterparty, and resulting therefore in a core rating of triple B low. However, what we did do is that we recognized the fact that the refinance was soft, and that a failure to refinance was not necessarily an event of default. And so there was some flexibility involved with that. The probability of default therefore kind of decreases, accordingly. As a result, we gave a one-notch uplift based on the kind of financial structure to arrive at a final rating of triple B. And so with that, that kind of covers the kind of two case studies. We have a number of questions here, which I will get to now. Thank you very much for those. I'll take these in order that they were received. And so the first question is there a cap from the rating of the off-taker? What would allow it to go above, and what if there are two off-takers? And so in general, the off-taker rating does cap the rating of the project finance or in digital infrastructure finance methodology, because ultimately the revenue payments, the lease payments that come from that serve the debt, come from this rated entity. So that's the general statement. Now, in many cases, we have gone above the rating of the off-taker for a couple of reasons, including if we feel that there are easily replaceable off-takers, such that, in the case of data centers, for instance, if we feel that in the case of portfolio data centers, sorry, if we feel that any one data center, if it went off lease, could be replaced by another off-taker, then the combined credit of the tenants does not necessarily constrain that data center rating, and it did not in the vault rating. But that is assessed really on a case-by-case basis. As a general rule, the kind of credit of the off-takers does constrain a rating. Another example actually of a case where it didn't was a private telecom tower lease, ground lease transaction that we did actually, where the towers were leased to, there were towers, there were a couple of other assets as well. And in that case, the assumption was that if any one tower went off lease, there will be other telecom companies that could come and take that. I mean, so again, that credit quality, combined credit quality of the offtake does not necessarily constrain that rating. But again, that is a case-by-case basis. As a general rule, we do apply that. Another question comes, what will be the impact of programs like BEAD, grants for expanding broadband in rural communities, be for the future of digital infrastructure? Um, I guess from a rating perspective, we don't know that there is any real impact on ratings of specific transactions for rural-based digital infrastructure. We have seen actually a lot of transactions kind of come in, or interest come in for transactions that are based on these type of rural grants. And what I can say to that is, to the extent that that grant helps the financeability of the contract, for instance, such that it reduces the overall capital cost and the financing then resolves, less debt and less equity, because say 50% or 60% of the capital cost has been covered by this grant, then that is a credit positive and could turn a project from something which is initially not investment grade or not rateable to something which is investment grade. Rural communities, from our perspective, have a plus and a minus. On the one hand, because of the fact that it is a rural community with more sparser population, that demand is not necessarily as great as an urban area. But on the other hand, on the same characteristic, the economics of operating in the area are tougher, such that someone who goes and actually builds that infrastructure is not likely to see um, significant competition, and so you have a plus and minus for rural infrastructure. Excuse me. I will say that we recently rated a pretty significant fiber network in Europe that was kind of geared towards tier 3 and tier 4 markets. And there was significant government and regulatory support, offering of concessions and things of that nature that kind of enabled us to view that infrastructure as very kind of very sticky revenue because of the regulatory framework that around that. A couple of questions here from someone. How do you accommodate refinancing risk in the rating if the debt matures in year 7, but the offtake has a much longer maturity? Can you still be investment grade if there's refi risk? When, i.e., what year do you look at cash flow to debt ratio, given that cash flow can be negative in the early years? If the project relies on one or several off-takers, to make a linkage to the rating of the off-taker, etc. So on the off-taker, I did kind of address that in the earlier question, but happy to kind of discuss in further detail if this person is interested. Refinancing risk, I think we kind of covered really briefly in one of the case studies, but again, what we do for refinancing risk is that we will impose a refinance structure to the useful asset life. We will impose a amortization structure, and with an appropriately conservative interest rate. We then assess, as I said, what that rating of a refinance will likely come out to be. And the rating of the original debt could be constrained accordingly. I do have to emphasize that even if the rating of the refinance, as we see it, does not come out to be investment grade, that does not necessarily preclude your debt from being rated investment grade, but it will constrain what that rating can be. And we generally like to say that the rating of the original debt shouldn't be more than roughly one rating category above what the assessed rating of the refinance is. So again, if your refinance comes out at, say, a double B mid, then in general, we don't believe that the original debt can be much higher than a triple B mid. So so hopefully that kind of addresses those questions. What year do we look at the cash flow to debt ratio? I would say that really happens more on a normalized basis. And so agreed that, cash flow to debt can change over time as you amortize. I think the balancing is that the cash flow to debt often applies when you have a kind of bullet bond or non-amortizing structure. Um, which necessarily kind of results in a high DSCR because of being interest only. And so kind of the lower assessed cash flow debt will kind of balance out that high DSCR. If you are amortizing, then the DSCR will be relatively lower. But that is again, then balanced out by the fact that cash flow debt does decrease over time. So on a normalized basis, that cash flow debt will be somewhat lower. I do have to emphasize, as I said, also that really the operative metric generally tends to be the DSCR. But we do look at the cash flow debt because that is a feature of many of the structures that we have that have been presented to us. Another question, what would make you rate a digital infrastructure project under the digital methodology versus the corporate methodology? That's a very good question, actually, because many people come to us sometimes with the structure that they hope to rate in with the digital infrastructure methodology, given its higher leverage allowance and things of that nature. Um, I would say that, as I mentioned before, the project finance or digital infrastructure methodology does assume a fairly fixed structure. And what that means is that we expect the asset to remain relatively static over time. Um, we expect the debt to remain relatively static over time. So it kind of, it's issued and then amortizes, or at the very least, is a bullet bond that refinances. To the extent that your issuer or your project is looking for flexibility to expand, to buy or expand to new areas. As I said, for a fiber co, for instance, the fiber co starts out in a set of urban or set of areas, and then wants to acquire or expand operations into a new area. To the extent that you're able to issue additional debt to finance such operations or such expansions without a rating agency confirmation. Um, you know, these are features that make it more of a corporate than a digital infrastructure or project finance. So we in digital infrastructure can accommodate some degree of flexibility in increasing assets or portfolio management, and such that we've seen cases where a fiber co with operating assets in a number of cities have wanted the flexibility to sell off some of those cities over time and use those proceeds to buy new assets. From our perspective, that really is more of a corporate than a project finance, and as a result, the more features you have of that nature that make it look like a corporate, the more corporate it actually is, and we would likely kind of refer you to the corporate group for those type of transactions. A request to have somewhat clearer slides, and that definitely is. Unfortunately, BrightTalk requires that these be converted to images, and so sometimes in that conversion process, some of the clarity goes away. Slides that will be kind of circulated will be PDFs, and so will be very clear. Another question on your data center example, there's a cash sweep kicking in maturity. What if the default instead? Will you still look at the refinance met DSCR? If the default, so if it is a hard refinance, the approach is actually very similar, because actually the digital infrastructure methodology by nature assumes a hard refinance. And so we actually have had issuers come to us and say that our approach is a little bit more punitive that they would like to see, because they view that flexibility to not refinance is a credit feature. However, when you look at the deal as a whole, you can see that the pricing of the original debt, is priced to the original refinance date. So then, 5-year debt would be priced using a 5-year rate. 7-year debt would be priced using a 7-year date rate. The penalty interest that it kicks in, actually, if you fail to refinance, is also very punitive. The whole structure just says that it is intended to be refinanced at that time, and so we treat it as such. Our only flexibility is that we do recognize, because of the soft nature, we did give it a 1-notch uplift. And so to your question, if there was a default instead of the sweep kicking in, we would not have that 1-notch uplift. And therefore, you would be at that whatever rating the original rating was. I would also say that the fact that we assess the initial refinance based on the assumption of a hard refinance does mean that it is, again, some issuers feel that to be more punitive than required. A final question: when you rate data center deals, especially when assessing risk associated with specific property, do you use only the information given by the issuer, or do you go beyond that, utilizing your knowledge of local market, tenant, etc.? And clearly, as with any rating agency, we do our own due diligence. So you know, within DBRS Morningstar, we have real estate experts who are very familiar with the data center market. In fact, some data centers, depending on how they are structured, if they are REITs, for instance, will actually be rated by the real estate group as opposed to, say, structured finance or project finance. Um, and so, yes, definitely, we do look at the local market. We do look at our assessment of those local conditions in kind of assessing the risk associated with data centers. Obviously, we will look at the information that's provided by the issuer, and that forms the core part of what our due diligence is. But clearly, we will look at other information as well. Um, so I hope that that was helpful to people. I don't see any other questions. We do have another couple of minutes if anyone else has any other questions. Otherwise, um, happy to entertain entertain further discussions if people are interested in uh, in this. We will be circulating the slides to register participants, and they will be, as I said, in PDF format, so maybe clearer than what is showing on the screen right now. I will wait another couple seconds to see if there are any final questions coming in. And seeing none, I think we will end the webinar at this time. Thank you very much for participating. We appreciate your interest, and have a good day. Bye-bye.